You open your banking app, see the rent payment leave, and feel the same thought you had last month. That money is gone. Then you open social media and see someone your age standing beside a front door, holding a set of keys, smiling under a caption about finally becoming a homeowner. A relative asks when you are going to stop paying someone else's mortgage. A friend says renting is throwing money away, and suddenly the apartment that gave you a place to live starts feeling like proof that you are falling behind. But here is the part nobody explains clearly. Buying a home can build wealth. It can also create so much monthly pressure that the house becomes the reason you cannot save, invest, move, change jobs, or recover from one expensive repair. The real decision is not simply rent versus mortgage. It is whether the total cost of the home fits the total life you are trying to build. Because renting can keep you from building ownership, but buying too early can keep you from building everything else. Renting feels painful because the payment does not create an asset with your name on it. You pay for 12 months, and at the end of the year, you do not own part of the kitchen, the bedroom, or the building. The landlord keeps the property. You keep the receipts. That is why renting is throwing money away sounds so convincing. It turns a complicated decision into a simple picture. One person pays and owns nothing, while another person pays and builds equity. But rent is not payment for nothing. It buys shelter, location, flexibility, and the ability to live without first selling an asset worth hundreds of thousands of dollars. It also transfers certain risks to the owner. When the roof leaks, the water heater fails, or the building needs major work, the renter may face inconvenience, but the owner faces the bill. That does not make renting automatically better. It means the rent payment and the mortgage payment are not buying the same package. One buys the right to live somewhere with fewer long-term obligations. The other buys ownership while making you responsible for nearly everything that ownership touches. And that responsibility matters more than the word equity makes it sound. A mortgage payment is usually the number people compare with rent, but the mortgage is only the entrance fee to the ownership system. At the end of July 2026, Freddie Mac reported an average 30-year fixed mortgage rate of 6.66%. On a $350,000 home with 10% down, a $315,000 loan at that rate would create a principal and interest payment of roughly $2,024 a month before property taxes, homeowners insurance, mortgage insurance, association fees, utilities, maintenance, or repairs enter the picture. That is where many rent versus buy comparisons become misleading. Someone says, my rent is $2,000 and the mortgage would be about $2,000, so buying is obviously smarter. But if the complete ownership cost becomes $2,700, the decision is no longer between two equal payments. It is between a known housing cost and a larger cost with more responsibility attached. The Consumer Financial Protection Bureau lists appraisal fees, title insurance, government taxes, prepaid property taxes, homeowners insurance, and interest among the charges that may appear at closing. Those costs can require thousands of dollars beyond the down payment. So the person who says, I finally saved the down payment, may still not have enough to buy safely. They may have enough to complete the transaction. That is different. If buying the home empties the emergency fund, the first repair does not feel like normal ownership. It feels like a financial ambush. The air conditioner fails in the same month the car needs work. A pipe leaks behind a wall. The insurance premium rises. The property tax bill changes. The house does not ask whether this is a convenient year. It simply sends the cost to the person whose name is on the deed. HUD has specifically noted that insurance, property taxes, and maintenance have contributed to rising cost burdens for homeowners. That matters because the financial strain of ownership is not limited to the purchase price or the interest rate. This is why buying too early can look like progress from the outside while quietly weakening the inside of your finances. You may own the home but stop contributing to retirement. You may build equity but carry credit card debt for repairs. You may have an extra bedroom but lose the freedom to take a better job in another city. You may finally have the status of being a homeowner while becoming more dependent on every paycheck arriving exactly on time. A house can increase your net worth and reduce your financial margin at the same time. That is the contradiction most people are never taught to measure. The pressure to buy becomes even stronger because housing is not treated like an ordinary purchase. It is treated like a life milestone. People rarely ask, "When are you going to buy a more expensive refrigerator?" But they will ask when you are buying a home, as if adulthood has a closing date. Older relatives may compare today's choice with the market they entered decades ago, when prices, rates, wages, insurance costs, and down payment expectations were different. Friends may talk about the value their homes gained, without mentioning the cash they spent on renovations, interest, taxes, or repairs. Social media shows the keys, the empty living room, and the smiling photo beside the sold sign. It does not show the buyer 6 months later, staring at a repair estimate and wondering which savings goal has to be paused. The visible moment is ownership. The invisible part is carrying it. And because ownership is visible, renting can start to feel embarrassing even when it is supporting a smarter plan. You might be renting close to work, saving transportation costs, building a strong emergency fund, investing consistently, and keeping the ability to move for a higher paying opportunity. Someone else may own a larger home, commute farther, have almost no liquid savings, and use credit whenever the property needs attention. From the outside, the owner appears ahead. On paper, the renter may be building more flexibility and financial strength. This is not an argument that renting secretly makes everyone wealthier. Renting without a larger plan can become its own trap. If the lower responsibility of renting simply turns into higher lifestyle spending, nothing is being built. If someone rents for years but never saves the difference, never invests, and never prepares for rising housing costs, flexibility can become drift. The advantage of renting only matters when the space it creates is used deliberately. That is the part missing from both slogans. Renting is throwing money away, ignores what rent protects you from. Buying is too expensive, ignores the long-term value ownership can create when the purchase is affordable, stable, and held long enough. The decision is not about choosing the morally correct housing category. It is about choosing which set of costs and risks your current life can carry. Imagine two people earning the same income. The first buys as soon as a lender approves the loan. The payment technically fits, but only because retirement contributions stay small. Travel disappears, and every repair goes on a credit card. The second keeps renting for 3 more years. During that time, they build cash reserves, reduce debt, improve their credit, and learn what ownership actually costs in the neighborhood they want. 3 years later, the first person has some equity, but they also have financial exhaustion and little room to make a different decision. The second person has no home equity yet, but they can buy with a larger buffer, a lower debt load, and less fear that one broken appliance will undo the entire plan. Who is ahead? The answer depends on what you measure. If you measure only ownership, the first person wins immediately. If you measure resilience, flexibility, retirement progress, debt, and the ability to stay in the home without constant pressure, the answer becomes less obvious. This is why the timing matters almost as much as the purchase. Buying can work well when you expect to stay long enough for the transaction cost to make sense, when the full monthly cost leaves room for other goals, and when you still have cash after closing. It becomes more dangerous when your job, relationship, location, or income may change soon. A home is expensive to enter, expensive to maintain, and expensive to leave. Selling may involve repairs, preparation, commissions, moving expenses, and the risk that the market does not cooperate with your timeline. Renting lets you make a one-year decision. Buying can turn today's decision into a commitment that follows you through several versions of your life. That commitment is not bad, but it should be chosen, not absorbed through pressure. The wider lesson is that housing does more than decide where you sleep. It shapes how much of your future income is already claimed. Two people can have the same salary and completely different financial lives because one chose a housing cost that left room, while the other chose a housing identity that consumed the room. The person with the nicer home may look wealthier. The person with the lower total housing burden may be the one quietly investing, changing jobs without panic, and building the cash needed to survive a difficult year. Wealth is not always visible from the driveway. Sometimes the strongest financial position is hidden in what a person has not committed themselves to yet. The right home is not the one that proves you made it. It is the one your life can carry without losing its future. That changes how you should make the decision. Start by comparing total monthly cost, not rent against principal and interest. Estimate the mortgage, taxes, insurance, mortgage insurance, association fees, higher utilities, routine maintenance, and a realistic repair reserve. The point is not to predict every future expense perfectly. The point is to stop pretending the mortgage is the entire home. Then look at what remains after the purchase, not what remains before closing. If the down payment and closing costs leave you with almost no emergency savings, the home may be affordable to acquire but unsafe to own. A strong purchase does not end with the keys. It leaves enough cash for life to continue after the photo is taken. Next, test the decision against change. What happens if you need to move, lose income, support a family member, have a child, replace a vehicle, or handle a major repair? You do not need to build your life around the worst possible scenario, but a home that only works when nothing changes is not stable. It is a fragile plan wearing a permanent address. Also compare what renting allows you to build. If renting is cheaper, give the difference a job before lifestyle absorbs it. Use part of it to reduce debt, strengthen emergency savings, invest, or grow a future down payment. Otherwise, the financial advantage of renting can disappear without leaving anything behind. And remove the audience from the decision. Your parents do not make the payment. Your friends do not cover the repair. The people liking the new home photo do not live inside the monthly pressure. Advice can help, but the final choice has to fit your income, your location, your career, your relationships, your timeline, and your tolerance for responsibility. Buying a home is not the moment you stop being behind. Renting is not proof that you failed to become an adult. They are financial tools with different costs. The goal is not to defend renting forever or rush into ownership as quickly as possible. The goal is to reach the point where buying strengthens your life instead of becoming the most impressive source of stress you have ever purchased. Because a home should give you more than an address. It should give your life a stable place to grow. And when the numbers, the timing, and the responsibility finally fit, you will not need pressure to convince you. The decision will make sense even after the excitement wears off. If this made you look at money differently, subscribe to Fiscal Sense, because this channel breaks down the hidden money patterns that keep hardworking people stuck and the quiet shifts that help money finally become stability.